In this video, I will show you a simple but yet super effective 5-minute scalping trading strategy that uses stochastic and moving average indicators to help you generate quick and significant returns when executed correctly. So make sure to watch this video fully to understand this strategy, and without further ado, let's get started. Traders have relied on a variety of technical indicators as well as a variety of other tools to determine correct trading positions. In trading, the use of these tools allows traders to achieve consistent gains while also sorting out the most profitable trades with the lowest risk possible. The stochastic oscillator is one of the most widely used indicators in trading, and I have been implementing it lately a lot as I started to see that if you apply it in the correct order with other tools, it can bring you astonishing results. The stochastic trading indicator has a huge advantage because it summarizes market data in such a compact way that you may place trades with only one use of this indicator. And to be honest, those who have been following me for a while, you know that I never allow you to throw your entire fate in a single indicator. So to achieve more accurate trading positions, I frequently combine this indicator with other indicators as well as tools such as moving averages, simple price action, fundamental and technical analysis. I also love to implement RSI, so the list is endless. However, for this 5-minute scalping trading strategy, we will add the 200 moving average to assist us in understanding the market structure and overall move. This strategy may be used for a wide range of trading assets, of course, including forex pairs, stocks, commodities, and so on. In other words, even if you trade forex or you trade something different, and somehow I ended up on your YouTube homepage suggesting this very efficient 5-minute scalping trading strategy, just to let you know that you are not limited to using this 5-minute scalping strategy on one asset, so feel free to explore and thank me later. Before we continue, I invite you to join me on my Discord server, where I would love to have you as my member. So when you join our Discord, you'll have exclusive access to our trading ideas for forex, cryptocurrency, useful links, live streams, and so much more. If you are tired of trading alone, or you simply want to join the community and be a huge part of it, or we can all chat and chill, you are more than welcome to join us. I will leave the link in my description box down below. I can't wait to meet you there. So the first step in implementing this 5-minute scalping trading strategy is ensuring that the appropriate indicators are present on the chart. Navigate to the indicators, type moving average, click on it. Nice. Now you do the same for the stochastic. You got it. It's on your chart. Now we need to adjust the settings for the moving average. Simply click here, go to the input section, and change the value to 200. Now for the stochastic, we will leave the settings as it is because it's a great match when it comes to this 5-minute scalping trading strategy. The rule of thumb in any scalping day or swing trading strategy, you must follow the trend if you're looking for a long run success using it. In this case, our overall trend and market structure will be identified on a 1-hour chart, and for an entry we will use 5-minute time frame. Incorporating the 200-day moving average is made simple by analyzing the market in relation to the 200-day moving average line. If the price is higher than the moving average, we are in an uptrend. In addition, I find it quite beneficial to utilize 200 moving average as a support in an uptrend. For example, on this chart, you can see that every time the price has reached the 200-day moving average, it has bounced of it to the upside, indicating that it's a strong point of a support from which sellers have been unable to break through. The same reasoning may be used to the downward trend. As long as the price is below the 200-day moving average, we are in a bearish market. If you can observe a multiple rejections of that moving average and is going towards a downside, it clearly indicates that buyers were unable to break through a significant zone of a resistance. So now, as I explain how the moving average works in this strategy, let me share how we can take advantage of the stochastic indicator to catch those quick profits. It is important to understand how the indicator works because you cannot just simply blop the indicator on the chart and randomly place a trade. The stochastic oscillator is an indicator that helps determine when the price of an asset is about to change direction. It does this by giving signals as whether an asset is overbought or oversold. So if the asset is overbought, it could be due for a reversal to the downside, and if if it's oversold, it could be due for a reversal to the upside. Under the typical settings, the overbought zone is located between 80 and 100 levels on the indicator chart, while the oversold zone would be found between 0 and 20 levels. So the signal line is one of the moving average lines used in a stochastic oscillator, and it reacts to the price changes far more quickly than the other lines in the oscillator. This quicker line has a tendency to provide early signals when the asset is about to become overbought or oversold. It's important to realize that increasing number of overbought and oversold zones in the indicator will result in a faster signal production, but it will also increase a number of false signals as well. Therefore, as I said in the beginning of the video, that the default settings for the stochastic indicator are believed to be the most successful ones when it comes to trading, and actually traders are hardly modify them. So let's put all of this information together in the chart. Keep in mind that you should always backtest your trading strategies to ensure that they are appropriate for your needs and your trading style. I have the USD JPY currency pair, and if you ever consider scalping USD JPY, it is an excellent pair to go to since it has a tendency to move steadily and with a clear market structure, making it much more simpler to catch that entry. So this is a 1 hour chart, and as you can see, there is a strong trend towards the downside. We can see several rejections of the trend. The price is making lower lows, and the 200-day moving average line is far above the candlesticks, which indicating that we are in a bearish market. So if I draw an area of a sensitivity over here, in this instance it would be a zone of support, right? We can now classify this price movement as a squeezed pattern, which has been broken, and the market is currently in a consolidation zone. And to be honest with you, on a 1 hour time frame, I prefer to highlight any support and resistance zones or chart patterns that I observe, which helps me to assess the broader market structure. A potential consolidation zone is also visible over here. However, even if the price retests the support zone, we should be able to make at least 70 pips before the market changes direction or at least breaks through the consolidation zone towards an upside or a downside. And as you probably know, the price usually moves in cycles of push exhaustion with a possible consolidation period afterward before continuing its move to the upside or the downside. So to summarize, even in this scenario, we know that our 1 hour trend is towards a downside. Therefore, we can predict that if the sellers are strong enough to break through this area of a support, all we can do is to wait for another retest and bearish engulfing candle closure before entering short. So now let's take a look at the 5-minute time frame. You are probably wondering, but wait, Christina, the price on the 5-minute is well above the moving averages. Should we still be looking for sell trades only? And my answer is yes. We know that our overall trend is towards a downside. We still have some room for the trade to retest support, so why not use it to catch a few pips? If you would take a closer look over here, we have a triple top chart pattern, which is a bearish pattern. So let's play a replay tool on to see what's happened next. And as you can see, the sellers pushed the price so hard that it broke the 200-day moving average, indicating exhaustion to the moving averages. As I said in the beginning of the video, the moving average stands really well as a moving support on resistance, and we have a closure of a bearish engulfing candle as well as a stochastic cross well above the 80 value, which indicates the overbought market. So based on what we see on the chart, this could be a good entry. The 1-to-1 risk ratio is pretty good for scalping as you constantly in and out of the trades. So let's play a replay tool on and see how the trade turned out after all. After the push exhaustion cycle, there was a consolidation movement, but again, it never hit a stop loss, and we had our 200 moving average as a resistance in this case. And what happened later on was the price broke our 1 hour support with further bearish pressure. Of course, you can move your stop loss to the entry once the trade reaches around 50% of your profit. In that case, you will have a risk-free trade, which I personally like to do, and I feel like a beginner and more experienced trader should do that as well. But hey, everyone manages their risk on their own. I just like to give out some advice on how to trade smart and profit out of it. So now, if you're looking to be super safe when using this 5-minute scalping strategy, you could potentially exit your trade over here as soon as you see a crossover below 20 value on the stochastic indicator, or you can continue making profits by letting the trade run until it starts to trend to the upside, making higher highs and breaking the 200 moving average average to the upside. So if you found this video helpful, make sure to watch this video next, because you can easily combine stochastic indicator and this strategy to receive maximum results.